Good afternoon, class, or I guess at this time of day, good evening, class. We're going to spend some time in Chapter 11 talking about financial markets, the demand for money, and some other aspects that we may have briefly touched on previously, but get a little more into detail with them tonight. But before we get started in Chapter 11, let's go back with Chapter 10 and recap, I guess, maybe some of the salient points of Chapter 10. And Chapter 10 starts off talking about what is money. And, the basic definition of money for most individuals, especially economists, is it's a medium of exchange. And when they talk about the functions of money, at least the authors in this text, they talk about medium of exchange, unit of account, and a store of value. So those are the three I guess, functions of money that the authors decide that they want to focus on. And then they talk for a few minutes about types of money. You've got commodity money, and you've got checkable accounts or checkable deposits. And checkable deposits are what most of us are trying to, I don't even want to say manage, but most of us are trying to allocate funds from to pay our daily bills, things like electricity, gas, water, internet, car payments, mortgage payments or rent payments, food, clothing. Mostly those are coming out of your checkable deposits. And then the authors spend a few minutes talking about measuring money, and the government measures it either M1 or M2, and economists use those two measurements, and policymakers use those two measurements to kind of allocate what policy decisions or to determine how to maybe utilize monetary policy if you're talking about the Federal Reserve. And then the text walks everybody through talking about banks and the functions of banks, and they get into some accounting concepts and terms, which maybe is actually review for a lot of you. If anybody's had really any basic accounting classes, a lot of those accounting terms are just going to be nothing more than review for you. But the authors are trying to tie it back to what we should be looking for when we're talking about banks. Of course, the FDIC insures our funds if it's a single account, 250. If it's multiple accounts, I guess up to 500,000 or 250,000 per account. But again, trying to, I guess, incentivize us as consumers to think about the banks and to somewhat monitor the activity of banks, because bankers, for the most part, it goes back into that definition of moral hazard. We have moral hazard in property and casualty, homeowners insurance, renter insurance, automobile insurance. You have it in healthcare, and especially have it in the banking system, because a lot of bank managers or presidents of banks are somewhat, I don't want to say maybe not incentivized, but are somewhat, we'll use the word incentivized, or somewhat incentivized to maybe pursue some high risk, high reward type of investments, because their understanding is if the bank were to fail, or if the bank were to run into financial issues, you got the FDIC setting out there that's going to cover everybody's losses, especially the consumer's losses. So that's where moral hazard ties into it. And we spent a few minutes the last time talking about moral hazard. Then we started talking about money creation and the deposit multiplier, and you can see how the impact of not only the multiplier, but reserves impact the money supply, impact the demand for money. We got into a few minutes about the regulation of banks, and that's pretty much driven for the most part by the Great Depression, not the Great Recession, but the Great Depression of the Great Depression of 29 to 33. So that's the historical dates that kind of span the Great Depression, but that led to a lot of activity, FDIC, regulation of banks, the Federal Reserve. Even though the Federal Reserve was created by the Federal Reserve Act of, I think it's 1913, but the Federal Reserve started taking a more active role in the regulation of banks simply because of some of the improprieties that occurred previous or right before the Great Depression hit in 29. And then lastly, talk for a few minutes about the government and the policy tools that the Federal Reserve can use. They can change reserve requirements. They can change the discount rate and the discount window. They can, I guess, alter or at least manage the supply of money through open market operations. And lastly, they can pay interest on reserves that banks allocate to the Federal Reserve, because the Federal Reserve requires banks to hold in reserve a percentage of their checkable deposits, and those checkable deposits, that rate tends to be about 10%. So, every 10%. So, let's say $1 million. Then the bank, if they have $1 million in checkable deposits, they have to hold 100,000 of that in a reserve with the Federal Reserve Bank and the Federal Reserve's vaults. And they use that to regulate the money supply. And it's really those tools are the drivers of monetary policy. And I think we're going on chapter 11. I think it's chapter 12 that talks about monetary policy. So we'll get into monetary policy after we finish up chapter 11. So chapter 11, we're going to spend some time talking about financial markets and the economy. And the definition that the text gives you on financial markets: it's a market where financial instruments are traded. Kind of makes sense, I guess, financial instruments. When you're talking about financial instruments, you're talking about stocks and bonds and Bitcoin and futures and options. And when you think about the financial markets, most people automatically go to the New York Stock Exchange or the NASDAQ or the S&P 500. But they forget and those are mostly, New York based, but they forget about the Chicago kind of financial markets. And you've got Chicago Board of Trade and the Chicago Mercantile Exchange, which, especially when you're talking about futures and options, that's where you're focusing on, are those Chicago markets. Financial instruments, and the definition they provide you in the text, is documents that represent agreements between two or more parties about the rights to payments of money. Financial instrument. I go to I touch base with my broker. I put in a buy account for 100 shares of GE, and it goes into New York Stock Exchange. I pay whatever the spot price is for it. Let's say it's $100. I don't even know what the spot price is today on GE, but let's say I pay $100 for those 100 shares. I allocate money to the stock exchange. I get control of the shares. Whoever sells me the shares, could be one person, could be multiple people selling enough shares to get to 100 shares. They receive the funds that I provide, and then I sit back and I can do, because I own the right to those. Again, going back to property rights that we talked about in some of the earlier chapters, I own the rights to that 100 shares of GE stock. If GE stock does well and the price goes from $100 a share to $120 a share, I can sell it, and I can make $20 a share, and I can pay the capital gains tax on it, and pocket what money I have left over once all the taxes have been paid on it. The other option is I can just hang on to that, hang on to it for a little while. Maybe I don't want to take $120 for it. Maybe I think that the future earning potential of GE is greater than $120 a share, and so I hang on to it, and maybe I get some 4 or 5% dividend on GE stock. So I'm as a investor, and I'm buying a financial instrument. In this example, it's a piece of paper that says I own 100 shares of GE stock, or I may own 100 pieces of paper, one share per, one piece of paper for one stock share. But at the end of the day, I have the potential to either earn money by capital appreciation or earn money through dividends that the stock price or the stock, the stock in the company may pay per share of stock. So that's the good part of it. I can also, I pay $100 a share, and GE blows a couple of quarterly financial reports, and now all of a sudden my share is only worth $80 a share. And I've lost $20 a share on it. And maybe they're doing so poorly that they don't even pay any dividends. So the stock market, the bond market, all financial instruments, there is some level of risk involved in owning financial instruments. And we'll spend a few minutes talking about that a little later in the chapter. But financial instruments are traded, sold, bought, whatever terminology you want to use, to raise funds, save money, reduce exposure to risk, or increase exposure to risk via a speculator, because the speculator is willing to accept a higher level of risk than maybe other consumers, with the understanding there is a potential significant reward or significant return on investment for accepting that maybe higher level of risk than others are willing to accept. When it comes to raising capital, entities, especially profit maximizing entities, raise money to fund business ventures. And that's, mostly considered financial capital. With that financial capital, they may turn around and purchase capital stock. Remember, capital stock is one of your factors of production. Remember, factors of production that you learned from your basic, micro classes, and we actually talked about them in the first, I think, 4 chapters of this class or this, text. You've got labor, capital stock, which a lot of this money that is raised through the financial market is used to purchase capital stock. You've got natural resources, can include a lot of natural resources, but most people think about land. You've got the technology and the entrepreneurship, and those two are more focused on the technological production process, the black box. It is the production function where inputs are going in one end and outputs are coming out the other end. So financial markets are used to raise capital. Then the financial capital that they raise in the financial market is used to fund capital stock. Again, back to your factor of production. And when you're talking about raising capital, most people think about 2 types of mechanisms to raise capital. They think about stocks and they think about bonds. Stocks is a financial asset that represents partial ownership of a corporation, bought and sold at exchanges, New York Stock Exchange, NASDAQ, S&P 500, American Stock Exchange. Basically, it's bought and sold in centralized markets, and those are just the exchanges within the United States. There are a lot of state exchanges or exchange markets if you look at the global economy, but right now I'm just talking about the economy here in the United States. And investment bank facilitates the transactions. So it's easy to buy and sell shares of stock. I mean, it is just like, you can either do it on the internet. Maybe you've got a Schwab account. Maybe you've got a Fidelity investment account. I mean, there's lots of money, of financial facilitators out there that will help you buy and sell stock. And when we're talking about selling stock, there's 2 types of stocks. And the 2 types of stocks, depending on which it is, it's going to impact the aggregate demand. So you've got the initial sale. And so that's where GE comes to market and says, I've got 100,000 shares that I want to sell. That's the initial sale. Then you've got secondary sale. So on the initial sale, if you've got a company like GE that's already in the market, that's already gone public, what they say going public, they've already gone public, they're just selling it to at the spot price. Whatever that spot price is, they have X number of shares they want to sell, they want to raise some capital. If you've got a smaller company that maybe has not gone public and is maybe not listed on one of the exchanges, they have what they call initial public offerings. And you hear the talking heads on Fox and CNN and Wall Street, Barron's, they all talk about IPOs. And those are initial public offerings. And that's where a company's coming on. They're going to sell some shares in their company, and with the understanding they can help raise some capital. So that's the initial sale. That's kind of considered the primary market. Then you've got secondary market. So you're in New York City, and you decide you've got some shares of a company that you bought when they went public, and you bought it when it was an IPO offering, and so you decide it's done well for you. You want to cash in and count your earnings. You turn around and you call your broker and you say, hey, I want to sell 1,000 shares of whatever the company is, and I decide at the same time I want to buy 1,000 shares. So I buy your 1,000 shares at whatever the spot price happens to be. I pay you the money. You take the money. You give me the shares. That is the secondary market. That's what's considered secondary sales, because then I may take it, hold it for a while, turn around, sell it to somebody else. So it's just you're churning those initial shares of stocks. They just keep changing hands. So it's just like a dollar bill is printed, and it changes hands thousands of times before it is called back into taken out of circulation by the Fed and destroyed, so they can print new money or print money that's because dollar bills wear out over time. And then you've got you got stocks. You're buying equity, you're buying a piece of a company, and then you turn around, you got bonds, legally binding. It's a legally binding IOU, I guess, is the easiest way to look at it. It's a contractual understanding between buyers and sellers of bonds. They mature, they come due at different times, the initial sale versus secondary sales. And again, there's an initial sale, a primary market, and there's a secondary market. And everybody that dabbles in the bond market understands that they're either playing in the primary market or they're playing in the secondary market. And interest is the price a borrower must pay for the use of other people's money. You go to your local bank, your local credit union, wherever you may even go to the local automobile dealership if you're looking to buy a car. And you buy the car, and you either, if you don't have enough money to pay cash for it, which most of us don't, you take the money and you either borrow the money from the bank, you borrow it from, again, your credit union, or you actually, work a loan out with the automobile dealer, who typically goes back to the quote bank that is loaning the money. So, Mercedes Financial, you've got BMW Finance, you've got all of these automobile makers that have a financial arm that helps float these loans for automobiles. And as you're buying that, you're going to pay interest on that for as long as you own the car, or until you pay off the loan. And the interest rate is the interest that you have to pay, expressed as a percentage of the amount borrowed. So if you borrow, I can't remember, I saw something on the internet today, some automobile outfit, maybe it's Volvo or somebody, I can't remember which car manufacturer, we're talking about, 5.5% interest, for 72 months. And they, think that's a great deal. It hadn't been that long ago that you could buy a car and you could get an interest rate of 1% to purchase an automobile. So that's your interest rate. That's the interest that you're going to pay. And then in addition to raising capital, individuals use financial markets to store wealth. They forego they forego purchases today for future purchases. Assist in storing wealth across time. So you're storing wealth across time with the expectation of being able to purchase something in the future. Helps savings grow instead of shrinking. You offset the adverse effects of inflation. So you're buying financial instruments, or you're investing in financial instruments, and you're in fairly good shape as long as the return on investment or the interest that you accrue or the increase in capital gains is greater than the inflation rate. And most people think about storing wealth. They're buying CDs, they've got a savings account, they're buying stocks, they're buying bonds. If you're working for a company, they are trying to incentivize you to, invest in an IRA. You've got a 401k. Maybe there's a pension plan that you can invest in. A lot of companies, if they're publicly traded, offer you the opportunity to buy shares of stock. And a lot of companies that I worked for in the past that were publicly traded, they would offer you shares of stock, and you could purchase those shares of stock at a 20% discount. So you're rather paying, if the stock was selling at $10 a share, rather than paying $10 a share, you could buy it for $8 a share. And you've already made 20% capital appreciation if you turned around and sold it. Now, a lot of these companies would like you to hold the stock for a lot longer because it incentivizes, at least the theory is, it incentivizes you to work harder because since you own stock in the company you work for, you want to see that stock value appreciate. And the theory is you're going to work harder, you're going to put forth more effort to ensure that the value of the company appreciates over time. And they talk about on storing wealth, liquidity. It's the ease at which financial instruments can be converted to cash. Most financial instruments, stocks, bonds, can be converted to cash fairly easily. IRAs, 401ks, you can convert those to cash, but if you convert them prior to a certain age range or a certain level of age or age parameter, you may be paying significant percentage or significant penalties on that, especially when you go to file your taxes. And most people, and let's just take student loans, for example. If you take out a student loan to help smooth not only consumption over time, but you're taking out a student loan to help smooth the stress of making ends meet while you're a student. But at some point, you're going to have to pay that, unless Biden comes along and forgives everybody's, student tuition loans, or it depends on how the political environment works. But otherwise, unless somebody forgives that student loan, you're on the hook to pay for that student loan and the interest that accrues on that student loan over time. Other kind of storing the wealth, everybody that works has to pay Social Security. And in fact, Social Security is a way that forces individuals to store wealth. It's automatically out of your paycheck. You pay, I think, 7.5%, and your employer pays 7.5% to get to the 15% that goes into Social Security. And so it smooths out not only savings over time, but it's going to smooth out consumption over time in the future when you retire. Same thing with 401k, same thing with the IRA. The other thing that we do in the financial markets is we try to reduce risk. Stock prices, you think about 2020, most people like to invest in stocks because they think it's going to store wealth. It's going to increase financial security going forward. Look what happened to everybody in 2020. I mean, the bottom fell out of the stock market because of COVID. And there were major functions of the stock market, of the financial market. I mean, it got really dicey in 2020. When you think about reducing, but most people think about stocks and bonds, that's a way to reduce risk. And it didn't work very well in 2020. You have farmers and speculators use, futures contracts, use futures contracts and options contracts to try to reduce risk. And a futures contract is a financial instrument that establishes the terms of a sale that will take place at a later time. And you think about most futures contracts or options contracts for that matter, they are on commodities with uniform quality. And when I was in graduate schools, my dissertation was, focused on futures and options, and I was looking at fat cattle and feeder cattle. You're talking about basically beef. So you had at the time companies like McDonald's and Burger King, and they were using the futures and options markets to minimize the risk of the beef that they were going to have to buy at some point in time to make their hamburgers. Wendy's, a lot of grocery store chains, a lot of people play in the futures and options markets to try to offset risk of price variations and fluctuations. And they try to most of it is based on commodities. And you have not only agricultural products, but you've got metals, you've got gas, you've got oil, you've got a lot of different products as long as it is a commodity with somewhat uniform quality. If you think about it, corn's corn, wheat's wheat, soybeans. And they will actually have contracts based on grades, but still, unless you own some kind of Jack and the Beanstalk, type of special bean or special corn or something, it's all the same type. It's a homogeneous commodity. It stabilizes the income streams and offsets expenses. The risk involved is if you buy or sell a futures contract or an options contract, you do open yourself to some level of risk if the price goes up or the price goes down. So you could be at risk, but at the same time, if you're a farmer and you know that you need $5 a bushel for your corn in September of 2024, you can go into the market and you can look and you can play around with the futures and option prices. And as long as there are some contracts that have a futures price of X number of dollars in September of next year, and it's at a price that you feel comfortable with, you may buy a futures contract for corn. Let's say you buy one for 5,000 bushels or 10,000 or 15,000 bushels of corn, and you can either hold that futures contract till it expires and turn around and sell your corn for that price, or you can trade the futures contract as you go along. But it's the way farmers, and not only grain farmers, but farmers that are trying to lock in the price of soybeans or corn that they're going to feed their cattle, they're going to use the futures and options prices to reduce the risk of the farming operation. Also, remember that you're looking at things like spot prices, and futures and options are based on expectations. What are your expectations for a homogeneous product in the future? You also hear people talk about don't put all your eggs in one basket, and you'll have farmers that will take and they'll buy a few futures contracts for their grain, and then they'll hold the grain just in a bin somewhere and hope that they can manage the price expectations. So they're diversifying. They've got some tied up in futures contracts to offset some risk, and they're going to hold some and see what they can do on the spot market. So, and that gets into what you're talking about, diversification. And you usually hear about diversification in the stock market, or diversification just in general in the financial markets, where you spread the risk across a lot of different stocks, or you have some in stocks, you have some in bonds, you hold some in CDs or some in money market accounts. But if you're a financial wizard, you're doing that. But if you're a farmer, you're doing the same thing. You're just going about it in a little different direction. And diversification, the definition is basically offset risk by diversifying, the practice of spreading wealth across multiple investments, stocks, bonds, money markets, CDs, cash. You're playing probabilities, the chance, and especially on the stock market, the chance you think about it, when you're playing probabilities, and this is, I don't know if it's somewhat inaccurate, but they talk in the text about the chance of all firms tanking is less than, it's the probability of that all happening at once is probably fairly low. However, there were a lot of firms tanked during COVID, so kind of makes you wonder about that. Now, if you want to really get diversified, you can go in and buy what's called a mutual fund, and a lot of people who put their money in a 401k are buying, parts of mutual funds, and it's a financial asset in which the pooled savings of many investors is risk to buy stocks, bonds, and other financial assets, proportionate share of earnings generated by each asset. So put your money in a mutual fund. Let's say it's a growth mutual fund, and the mutual fund, whoever's managing it, they're going out and they're buying, assets in, high growth types of firms. Or maybe you want some that's a little more, maybe a little risk averse, and you can buy a mutual fund with a lower level of risk. So there are a lot of opportunities in the financial market to offset risk and to minimize the oscillations of future consumption patterns, or the oscillations of future impacts to your savings. And then the last thing that they talk about on the financial markets is enabling speculation. And I'm not sure that the government in general is thrilled about financial markets enabling speculation, but at the same time, speculators help to make the markets move forward. They help to stabilize the financial markets. Financial markets enable speculation. You put your money where your hunch is, and that's what speculators are doing. They have a hunch that the price of GE is going to go up by 25% in 2024, and so they may be out there right now buying shares of GE, or they may be out there buying shares of GMC or IBM or whatever hunch that they think it's going to move forward in 2024. I listened to Fox Business this morning, and Stuart Varney, or whatever the guy's name is that comes on, and I'm not sure I like him that much as a TV personality, but he does have some individuals on his show that provide some insight into financial markets. So I usually, when I'm maybe eating breakfast, I sit there and listen to Stuart Varney's show for a while. And occasionally you'll pick up some I don't even call it advice. You'll pick up some opinions on what these talking heads think the market's going to do. And then so you can put your money where your hunch is based on reading the Wall Street Journal. Maybe you've got a little market speculation type model that you put together. I mean, economists are famous for developing models on how to speculate on the market. I'm not sure even have made a lot of money on it, but they think their market is just going to make them a bazillionaire, and kind of good luck with that. But there are a lot of hunches, and a lot of people play their hunches on the financial markets. You can buy a futures contract in September for $3, sell it in July for $10 less a fee, and you've made money on it. Buyers and sellers may use the same futures contract to speculate and to offset risk. So you've got buyers and sellers in there playing in that futures market, and you've got a buyer and a seller, and one may be trying to offset risk, the other be trying to speculate. And there was a financial textbook that they had us read when I was at Ohio State, and it was I can't even remember who wrote it, but it was something like a random walk down Wall Street. And I think that was it, random walk down Wall Street, or at least something along those lines. And there was a chapter in there, and this text goes back and talks about it too. There was a chapter in there talking about the 1600s and the tulip bulb effect. So I guess especially in Europe, somebody decided. Again, we talked about there's different um, types of exchange, and people value or intrinsic value in different types of exchange type commodities. And they decided, I guess, in 1600 that the tulip bulbs were, especially in Holland, were going to be the greatest thing since sliced bread. So they were speculating on the tulip market. And, speculators can destabilize a market. And the price is not only driven by intrinsic value, but by speculative spiral. And that's what happened with the tulip market. I mean, there was an intrinsic value. Yeah, you could plant a tulip bulb and it will grow flowers, and you can sell flowers and things. But there was also this speculative spiral on the tulip market that the speculators, just through supply and demand in that tulip bulb market, they were driving the price through the roof. And they a lot of people call it they call it the tulip bubble, and it goes back to financial markets talk about speculative bubbles or asset bubbles, and the bubbles pop it sometimes, and so prices plummet and wealth evaporates, and that's what happened in the tulip market. At some point, that bubble burst, and all the wealth that these speculators thought they had accrued just evaporated into thin air. And so that's what you have to worry about when you're talking about speculating on financial markets. And if it's bad enough, it can plunge an economy into a recession, and that's what happened in 2007 and 2008. That's they talk about the Great Recession, and the markets just the financial underpinnings just broke down on the markets, and we slid into the recession. Speculators can also stabilize prices by impacting the supply of a commodity. They can minimize price swings. And then you can, if you ever get into a situation like this, trying to figure out, what's going on or how to work it, just step back, get your pencil and paper, draw your little supply and demand curve, prices on the vertical, quantity on the horizontal, and play around with it. And a lot of the questions that you have, you can actually answer, even though it's a very simplistic model, you can actually answer with that supply and demand model. And we're going to, at this point, going to take just a quick break, kind of regroup. And when we come back, we're going to talk about the bond and foreign exchange markets. See everybody in a few minutes.